January 16th, 2024. Today we got a measured move up of the opening spike down, or we got essentially there. We were a tick or two, a couple ticks away. That's pretty, it's pretty common when you get a spike on the opening range to get a measured move of it either up or down, regardless of the direction. So if you get a spike like this and then you start to get a move up, I think you got to start thinking about, well, maybe we're going to go up for a measured move rather than down for a measured move. Because a lot of times, when you see this spike, you start thinking, well, maybe we're going to get a measured move down, and then you try to sell like 7, but 7's not a very good sell, and I'll go over that in a little bit. This is just an interesting fact. I was looking at the daily chart this morning. I usually look at the daily chart in the morning, and I saw that we essentially had a double top. It's not going to let me get back. So I saw you can see up to here, and I could see that essentially we had a double top with this and a potential sell below here. And I thought, it's a trading range. So the midpoint of a trading range is obviously going to be a magnet. And so I found that the midpoint was this low, or it ended up being like 4779.75. I did the exact one, but 4779.75, you can see, was almost the exact low of the day. So it was one tick away. So essentially this was a vacuum test of that midpoint of the trading range. And, up here was a test of this measured move. So it's just little things like that go to show that, every single place that the market stops and reverses is some sort of support or resistance on some sort of time frame. It's not necessarily worth it to, go through and try to find every single one. But, I always go on the daily chart in the morning and look for things that I think might be important during the day. And I thought the midpoint of the trading range might be important today. And, it ended up being almost the exact low of the day. But even things like, 18 and 19, that's a spike, right? So when you get a measured move down of a spike, what usually happens? You get a reversal attempt. You can see right there, that's where we got that reversal attempt. So, every single thing is some sort of support or resistance test on some kind of time frame, but not really worth looking through every little thing. That was just something that I happened to pick out today and happened to be correct. Bar one, a bear bar, but a big tail on the top and a big tail on the bottom. More of a doji bar, not really all that great. Followed through for the bears on bar two, but a big tail on the bottom, which is a problem. It's sell to close on two. Two is probably a reasonable sell for a scalp. But again, we're, big tail on one on both sides and a big tail on the bottom of two. We're probably going to end up going more sideways. Big tail on three as well. So now we have, 3 bars with tails. We could be forming some sort of parabolic wedge here on a lower time frame, right? Down, up 1, down, up 2, down, up 3. So we could be getting some sort of wedge here. And the follow through on bar 4 really isn't all that great. It's a small bar and it's a shrinking body. If you notice, these are bigger bodies and we have a shrinking body on 4. So not ideal. You have to also keep in mind that 80% of, 80% of the days are trading range opens. And what that really means is 80% of the time, there's at least a minor reversal on the open. So you have to be thinking, if you're selling down here, there's an 80% chance that you're going to get some sort of reversal attempt on the open. So probably not the best to be short down here, which is why when traders get the doji bar, they all just exit above it immediately. This sell to close bear trend wasn't all that strong because we had tails, big tails on one and tails and shrinking bodies. So it really wasn't all that great. Traders know that, so they get out quickly. And I think 6 was a big problem for the bears because 6 closed so strong. And if you're a bull and you bought above 5, you were able to make a 5-point scalp. Interestingly enough, the 5-point scalp was this midpoint. Yeah, so the 5-point scalp was exactly at the midpoint of the sell-off. So, this got basically put here because traders knew that they could make a 5-point scalp and then get to the midpoint. And once you get to the midpoint of a sell-off, limit order bears are probably going to step in and try to make a scalp. But why are bulls making money on stop orders if this is a bear trend, right? It doesn't really make sense that bulls are buying above a doji bar. We haven't even had a bull close yet today, and bulls just bought above a doji bar and they made money. They were able to make a reasonable scalp. So that should be a big red flag for bears. And, as a result, I don't think 7's a very good sell because do you think, if you're selling 7, you're hoping that you're selling a low 1 in a bear trend and you're going to get a big second leg down. But, you're probably selling a low 1 in a trade at the bottom of a trading range with all these tails, the doji bar, and then this. So this tells me with bulls making money that this is probably actually a trading range. And so 7's not a very good sell. Additionally, if you look at the top of 7, limit order bulls bought below 1 and they scaled in lower. And then 7, the tail on it, went right to the 1 low. So the bulls who bought below 1 and scaled in lower made money during 7. So you have stop order bulls making money and you have limit order bulls making money. And if you're selling 7, you're selling a low 1 at the bottom of a trading range. So Really not all that great. As a result, you get bar 8, a big bull bar closing near its high. And then if you look at 6 and 8, you got to be thinking to yourself, why are these bull bars closing so strong? You're right. So I think 8 is a reasonable swing. You could argue that it's 1 pullback 2 and it's 2 legs up, and that we're going to get some sort of reversal attempt. But I think more likely, um, these are really strong bars, and we're probably going to get at least 1 more leg up. Additionally, if you look, you have an open gap now with the 5 high and the 8 low. So the bears who sold above 5, scaled in higher, not able to get out of their first entry or break even with profit on their second entry. So you potentially have some trapped bears here. Another reason why you can buy above 8, trying to keep those traders trapped. Follow through for the bulls on bar 9, and more follow through for the bulls on bar 10. And if you're buying above 8, it's a lower probability trade. You get good follow through on 9, but you're probably not expecting much more. And then you get kind of a surprise on bar 10. Now you have 3 straight bars and it's by the close. And 10 does something really interesting as well. If you look, the bears, they don't sell below 7, but they'll probably sell above 7, expecting to make money. And they're trapped as well. So now that these bears are trapped, you have to be thinking, well, we have 2 open gaps. It's possible this lasts all day. With how strong this is, I doubt it's going to last all day. And, the context of the daily chart, we're towards the top of the trading range. So it's realistically probably not going to last all day, but it's possible. We have 2 open gaps, so you have to be thinking about that. And then you get a climactic bar on 11. And 11, the biggest looking bar, you got to be thinking that the bulls who bought above, 8 have almost 15 points. So they're probably going to take some off at 15 points, which is exactly what, bar 12 let bulls get 15 points. And that's why they were taking some off. And that's why there was sellers there. And, if you bought above 10, you got a really quick 5-point scalp. Probably most of those traders are just going to take that and run with that climactic of a bar. 8, 9, and 10 is a bull channel. And, 11 can be viewed as a climactic breakout above a bull channel, which has a low probability of success. It's true that 8 through 11 is enough for a second leg up, but the pullback could be deep. We could easily test to the bottom of bar 11, which is the bottom of the most recent buy climax. Now, why do I think that 15 points is important? Well, every 80 or I think it's 80 or 90% of days have a swing trade in the opening range that is 40% of an average day's range. And an average day's range over the past 15 to 20 days, I always track it. The average day's range is about 37. And so you figure about 40% of that is, roughly 15. And, I usually use round numbers. I don't like nitpick that it's like, oh, traders are going to scalp for 14.5. I usually just go to round numbers, which is, what Al does. It seems to make sense. So I thought 15 points would be an important place to scalp. And you can see there were sellers there on 12. 12, it's too climactic to sell below, but a lot of bulls will exit below. So you can see that's why bulls bought the close of 12. And we got move up on 13. But 13, if you bought above 11, if you bought above 11, you were hoping to get another bar like 11. There's maybe, 30% chance that you're just going to get another massive bull bar like 11 and get swept into a really humongous trend. So they knew buying above 11, they probably weren't going to make money immediately. So they probably scaled in lower and then are looking to get out around their first entry around break even and with a profit on their second entry. And those bulls selling is probably what caused a big piece of the sell-off on 14. Deep pullback on 14, but bulls bought it. You can see they bought around the moving average, expecting that we're going to get another leg up. And you can see we got follow through for the bulls 15, but not all that good. A tail on the top. Inside bar 16, potential final flag here. Probably sellers above, not too far above. Probably buyers not too far below. A doji bar on 17, and then a reversal down on 18. You can argue it's a wedge. 1, 2, 3. You can argue it's sort of a nested wedge. 1, 2, 3. Or you could say 1, 2, 3. And 14 also did something interesting, right? If you look at 1, the limit order bears who sold above 1 and scaled in higher were able to make money on 14. Why is that important? Well, if we're in the early stages of a bull trend day, you don't really want limit order bears to make money. When limit order bears make money, it shows weakness on the side of the bulls. So if the bulls are getting weaker up here, this is probably a trading range, and we're around the measured move target. So you got to think that bulls are probably going to exit below 18. And then you get a surprise on 19. And lo and behold, if you sold below 18, you need the market to go 15.5 points in order for you to make your 15 points, because it needs to go, you're entering a tick below 18. It needs to go a tick past your limit order in order for you to get filled. And how many points down did we go? 15.75. So traders scalping with almost exactly 15 points. Sorry, I had to pause for a second there. But I think 19 is a really important bar because it tells you what? The single most important piece of information I think 19 gives you is that today is probably a trading range day. Because of how strong this is, and you had this in the beginning, and this is pretty strong. So it tells you it's probably not a bear trend day. So it's probably going to be a trading range day. And by the way, late in the day, when you get tests, you often get tests of the midpoint of the day if it's a trading range day. And that's what we were getting over here. This was just a test of the midpoint of the day. And we tried to get up to the open of the day, but we didn't quite. But you can see that this was just a test and we oscillated around the midpoint of the day for the remainder of the day. So this vacuum up was just heading towards the middle of the day. But anyways, why is 19 important? Because it tells you that today's probably a trading range day and gaps close on trading range days, which tells you that this 5 high is probably going to be an achievable magnet, right? So if you start to get a swing down, you got to look for the 5 high to be the target. You can see on 37, we basically reached it and then we found a bunch of buyers. Inside bar 20, low one short, probably not that good. 21, reversal up for the bulls. You're buying high in a trading range and it's a big tail, so big risk, really not all that good. Fall through the bulls 22, 23, but tail, probably a parabolic wedge on a lower time frame, really not all that good. Reversal down on 24, and notice that it was a failed breakout of the 18 bar range on 23. So oftentimes when you get a failed breakout of the 18 bar range, within a couple of bars, you end up getting a attempt at a reversal down or at a reversal in the other direction. I have a few examples. So failed breakouts of the 18 bar range and then breakouts in the other direction. You can see here, 18 bar range, failed breakout in the other direction of the 18 bar range. Same thing here, failed breakout of the 18 bar range, try to get a reversal down, ended up going back up. Failed breakout, reversal down, failed breakout here, reversal down. So you can see when you get a failed breakout of the 18 bar range, a lot of times you end up getting a reversal in the other direction. 24 trying to be that reversal. A lot of times when you get a double top like 1824 is, the second leg up is a buy climax. So reasonable to think that we're going to get a couple legs sideways down here. But bulls bought the close of 24, not letting it trigger, and then we got a reversal up 25, but it's a high one at the top of the trading range, not all that good. Traders are going to more use this bar to exit their longs, which is exactly what happened on 26. Bear bar on 27, inside bar, we're probably going a bit lower. It's a double top and we're high in the trading range overall. This is a trading range day. And we have magnets down here below that probably need to get tested. So I actually did something that I don't usually do today. When we got 28, so if you sit around the stock market long enough, you'll realize that after 28, you have a tail on 26, 27, 28. This could be a wedge on a lower time frame. And traders who buy the close of 28 are hoping to get a bull reversal bar up here for at least a scalp, because sometimes if you get a wedge, you get a reversal, but other times if you get a wedge, you get a breakout below the wedge, something like that. And I actually thought the breakout below the wedge was more likely because if it were towards the top of the range, and like I've been saying, and I thought we might get down to the neckline of the double top since that's a magnet as well. And so I sold the close of 28 thinking that if we just got a bull bar on 29, I'd get out above it. And we obviously didn't. So follow through 29 for the bears, breakout below a potential parabolic wedge on a lower time frame. And doji on 30, you got to expect relatively bad follow through, but the channel is pretty tight. Follow through for the bears on 31, 32. You can see we did break out below the neckline, and then that's where we initially found support. Doji on 33, inside bar, but probably sellers not too far above, probably buyers not too far below. But it's a bit dangerous down to be short down here since we're getting towards the bottom of the trading range. Double top 34, but I'm not selling below 34. You're selling at the bottom of a trading range after a pair of dojis. 35, a bull bar, but probably sellers up here, as I was saying. And 36, 37, back to always in short, clearly always in short. It was always in short all the way through here, and those traders didn't technically have to exit until 43, I don't think. But clearly back to always in short. If you got out for any reason, you can sell again below 36, fall through 37. Some traders trying to get out around the 5 high. You can see they were so eager to get out because it was very unlikely they were going to get trapped like this. So they were very eager to get out. So they got out a couple ticks above, causing a reversal up 38. So the limit order bulls who bought below 35 scaled in lower, made money. So this bear trend is not really all that strong. This is more of a limit order market. 39, a low one short. You can take it, but limit order bulls just made money. So you need to be quick to get out above the bull bar. You get follow through on 40 for the bears. We could be coming up on a midday reversal here. This channel is It's decently tight, but it's not all that great. So we could be coming up on a midday reversal here towards the bottom of the trading range. Follow through for the bears on 40, but as expected, once you get follow through in a trading range, it's only going to last a bar or two. And then disappointment 41. Second leg down 42 for the bears. So it could be 1 pullback, 2 pullback, 3. This whole thing is the spike. This whole thing is the spike, and then we have a pullback, and then channel down. So spike, just the bear spike, and then pullback and channel. I don't think there was any sort of measured move to be had here. Yeah, not really. But anyways, I always like checking that stuff. But spike, pullback, 3 pushes down, so it's a wedge. Reasonable to buy above 43. It's a midday reversal. It's low in the trading range. It's true the channel is tight, and this is probably a minor reversal. But in a trading range, which this is, nothing is ever as bad as it looks. So it's more okay to trade against tight channels in certain contexts, and I think this is one of those contexts. Disappointing follow through on 44 as you expect, but a bull bar on 45 closing near its high. A good bull bar, okay to buy here or here, I think. And then you get a climactic bar on 46. What was 46 testing? Well, at this point, you have this spike down. So where are we probably going to pull back to? It's a trading range day. We like to go to the midpoints of things. And that's exactly what we did on 46. So follow through for the bears on 46. And a big tail on the top, you can see, because traders were taking profits there. Disappointment on 47, and then a reversal up on 48. But if you're buying above 48, you're buying basically right at the open of the day, and you're buying right in the middle of a trading range. So it's really not all that good. We're probably always in long, but if you're buying above 48, you need to get swept into a big bull bar pretty quickly. You want a bar like 11 after 48. So you get disappointment on 49. And then when you get this disappointment, bulls buy about 48, disappointed 49, and then you get bulls essentially just exiting. They see 49, they know they're buying in the middle of a trading range, so they know they need to get out quickly, and they do, and that's what causes 50. 50 is closes stronger than expected, and you get follow through on 51. So I think it's back to sell the close. You could sell the close of 50, you could sell the close of 51. You get follow through 52, 53. Essentially, we're trying to, there's going to be bulls buying this low, but we're trying to get a breakout to a new low. The whole thing ends up being a wedge, 1, 2, 3. But 54 reversal attempt up, a high 1, but not all that great. We could be forming a major trend reversal here. You could argue that it's going to be 1, 2, and then some sort of wedge. Or we could also argue that this is a strong trend, and then you get a trend line break, and bulls are looking for a major trend reversal. I think the problem with that argument is that this is really strong. If this wasn't as strong, I think it would have made more sense for bulls to get some sort of really strong bull setup here and then get a strong reversal up. But this spike down was pretty good. 55, a bear bar closing near its low. If you'll notice, 56 was closing, was up here for the majority of the bar, and bulls are trying to get a lower low major trend reversal, which would have made sense because if you get that, then you probably have to get a higher low first. And why does the higher low make sense? Because this channel is pretty tight. So I figure if this bar had closed on its high, it would have been a reasonable buy, thinking we were going to get at least a little bit up and then a pullback and some kind of higher low, and then maybe work higher. Follow through, but it didn't end up happening. So bears got this. Bulls who are front running are disappointed. They're going to exit, and bears can sell, thinking that maybe we'll get lucky and get a bear trend. Follow through 57, 58, but just a breakout below the 36 bar range, which is still an 82.5% chance we break out of every day versus a 90% chance we break out of the 18 bar range. And you can see that we got right to that magnet that I was saying, the midpoint of the overall week, or the overall trading range we're on the daily chart. 59, 1, 2, 3. It's a wedge. It's probably a minor reversal with how tight this channel is, but you could argue that 58 was essentially a breakout attempt below the channel, and I think that most likely to fail. So I think you can buy above 50, 59, expecting 2 legs sideways to up. Some follow through 60, 59 trades below, or 61 trades below 60, but buyers below. Inside bar or failed breakout above 61 on 62, but just a breakout pullback 63. Some bulls will buy. Follow through on 64. This is good for the bulls. I think that, at this point, we're probably going for the midpoint of the day, or maybe, the 49 low where limited order bulls bought, got trapped. So I thought that would be a magnet, and the midpoint of the day would be a magnet, and they're in roughly the same area, so it made sense. Disappointing follow through for the bulls, doji on 65, which you kind of have to expect. Disappointment 66. Doji 67, 68, and reversal attempt down 69 after potential wedge, and it's a double top, but really not all that good selling right on the moving average. Bull bar 70, but not all that good. It's a tight trading range. You're buying the top of a tight trading range. I don't want to do that. We end up getting a pullback. I wouldn't be trading any of this. I think, once you start to see this tight trading range late in the day, I would just be done. I also have something interesting that I wanted to talk about. Boeing has dropped a really dramatic amount really quickly. And you can see we're right at the price level 200, which is psychological support since it's a big round number. I thought we were going to try and close this gap. We might try to close this gap as well. But look at how strong this rally was. I think we're in a tight trade, or we're in a trading range here overall. And this is really parabolic. And with how big this bar is today, it's making me think that this is probably a climactic move. I was looking at the weekly chart on it. And, this is such a strong bull channel up that I don't think that we're just going to sell straight off. I think that, we could easily get down to 180, but I thought that, you could argue 1, 2, 3, 4 wedge top. And it's all true. It's a double top with this. It's all a wedge top, but this is so strong that I'm thinking that we're going to probably have to bounce. And where to? Well, I thought that, a 50%, let's just assuming, this is the weekly chart. So it's just started the week. So I don't know how this bar is going to end up looking, but assuming that, we end up getting, some sort of, this is the final bar or this is the final low of the week, assume that we could get maybe a 50% bounce of the thing and bounce back up to here. So, obviously not financial advice, but I did buy some Boeing today because I think that, it's probably premature. But I just thought, my premise is basically this is strong enough. And again, maybe we close this gap. Maybe we get all the way down here. I can scale in. But I kind of thought, even bull channel line. I kind of think that overall, this is strong enough to get another leg up. And I think we're probably going to get a bounce for at least a couple of weeks. I'm not expecting us to get anywhere near up here, but I'm just going to see if we get a bounce for a couple of weeks and then see how it looks basically. On the daily chart, we're at kind of towards the top of a trading range. If you still below this double top, you're kind of expecting bad follow through, and you got a doji bar. And you can see we're just in the middle of a trading range overall. We're probably going to get a pullback of some kind, and then hopefully another leg up for the bulls at least. Bears hoping to just go sideways for 20, 30 bars and get a reversal down, try to close this gap. One more thing about the 5-minute chart. With this being a big wedge, it was most likely that, or when you get a big wedge, basically this wedge lasted how many bars? 41 bars. The correction is usually about half that amount of bars. So it's reasonable to think you're getting a 20 to 25 bar correction, which is kind of exactly where we're sitting. For stop orders today, I thought 8 was good. You could about to close 9, 10. I didn't sell 18. I thought this channel was too tight. But, first swing, it was probably fine. Thought you could have sold the close here, sold the close here, could have sold any of these bars. Probably could have sold below 39. You can buy above 43. But you probably got to find a way to get out of, I would scalp out a lot of it at the midpoint. And then this second leg up, you can see traders used it to sell rather than to buy more. So I think you got to find a way to get out below, faster than below 50. But you can probably sell below 51. You can probably buy above, you can probably sell, below 55. You can probably buy above 59. But this is kind of dangerous. And yeah, that's the day.